When it's time to buy a house, you may find there feels like there's a lot of rules. There's rules for everything. What kind of employment do you have? What's your credit score? What's your debt to income ratio? How much money are you putting down? It seems like there's rule after rule after rule. Well, this is done typically by Fannie Mae and Freddie Mac, and what this is, it helps to mitigate the risk and make sure that loans actually perform, meaning that payments are being made on these. So they usually use historical data. This is going to be, what has your payment history been like previously? And what's the likelihood of you continuing to make payments and be a successful homeowner? That's really what those are designed to do. Where it gets a little bit interesting though is Fannie Mae and Freddie Mac make these rules, but each individual lender can actually add rules on top of that. As an example, maybe Fannie Mae says your credit score has to be at least a 580. And that's the rule across the board, but Lender A says, we don't really like loaning to people below 600. Lender B says, we don't loan below 640 credit score because that's our appetite for risk. We found that it's a little too risky to go below that. So these are called lender overlays, and every lender has them to a certain degree. A good example would be VA. VA says, they don't put out a credit score limitation at all. You can look at VA rules and they don't say you have to have any credit score. But each lender will have a certain credit score. It could be all the way down to 500, but they have that overlay on there to help them run a successful bank. So as you go out and you shop for different, and you're looking for the right home loan for you, you want to look to see if you're not being qualified somewhere. Well, why is that? Is this a Fannie Mae rule, an FHA rule, a VA rule, or is it a bank overlay? And so you want to ask your loan officer, is this an overlay? And I think it would be a very healthy and good decision to even ask an additional bank if you have a concern about a typical rule that's in there. Now, a thing to really understand is that these overlays are not, selective. They are equitable across the board. That means everybody within that particular bank is subject to those overlays. Now, when you work with a mortgage broker, a little bit different than a mortgage bank. A mortgage broker can go out and they can actually shop these different banks for you. They may shop 15, 20, 25 different banks, and they have the ability to say, well, your situation may be this, and most banks don't like it, but I have a bank that can do it. And that allows them to go out and do that shopping for you. It could save you a lot of time and, quite possibly get you into a home ownership situation where you normally wouldn't have been able to purchase a home. So again, these are called overlays done by each individual lender. Give us a call if you have any other questions about this.